Money operates by rules. They aren't printed in your constitution, they weren't taught in school, and yet they've shaped wealth for more than 3 centuries. These rules decide who rises and who stays stuck. Most people have never heard of them. Ask yourself, why does wealth seem to flow in one direction? The rich remain rich. The poor struggle. Middle-class families work harder but fall behind. It isn't luck. It isn't a grand conspiracy. It's quiet, durable laws of money that have governed behavior since the early 1700s. Before we dive in, drop a comment. Where are you watching from, and what time is it there? I want to see how far these money laws traveled across countries, time zones, and generations. First law, Gresham's law. In plain English, bad money drives out good money. 3 centuries ago, coins were gold and silver. Governments shaved them or mixed in base metals to stretch supply. People noticed. They hoarded the high-quality coins and spent the cheap ones. Over time, the real money vanished. The weak money circulated. The same dynamic lives today. The metals changed into credit, debt, and trust. But the mechanism persists. By the way, if you love money, subscribe to the channel and give it a like. Now, let's continue. When central banks flood the system with easy money, low rates, abundant credit, bad money, meaning inflated and devalued units, crowds out good money like disciplined saving and patient capital. People stop saving and start speculating. They chase returns instead of stability. Who benefits? Those nearest to the money spigot. Banks, major corporations, and funds that receive new money first. By the time it reaches you through higher prices, loans, or wages, its purchasing power has already faded. Gresham's law isn't a museum piece. It's your paycheck losing strength every year. Second law, the Cantillon Effect, named after Richard Cantillon in the 18th century. Money is never neutral. When new money enters an economy, it doesn't lift all boats evenly. It arrives at specific docks, enriches early receivers, and erodes late receivers. Picture a field watered from one corner. The ground nearest the pipe gets soaked. The far edge stays dry. Today, that pipe runs through the financial system. When central banks expand balance sheets or governments spend aggressively, investors, corporations, and asset owners feel the gains first. Stocks rise, property surges, bonuses swell. Workers and savers face rising prices before wages catch up. You feel inflation before you feel the stimulus. This isn't theory, it's history. After 2008, the Federal Reserve expanded by trillions. Stocks tripled. The top's share of wealth jumped. Median incomes lagged. Housing ran away. That's the Cantillon effect in real time. New money raised asset prices long before paychecks recovered. Third law, Pareto's Principle, the 80-20 rule. In many systems, 80% of results come from 20% of participants. Applied to wealth, a minority controls the majority, and the imbalance tends to intensify. Sometimes it be 90-10, 95-5, even 99-1. Vilfredo Pareto observed in 1896 that 20% of Italians owned 80% of the land. Today, the same pattern shows up in global wealth, corporate profits, and even attention. A small group dominates outcomes because systems compound advantages. These laws aren't moral judgments. They're structural. Like gravity, they pull value in predictable ways. Gresham explains how quality decays when money is diluted. Cantillon explains why early receivers win. Pareto explains why concentration keeps rising. Together, they form the invisible architecture of modern finance, so resilient that revolutions, wars, and crises haven't erased it. Now, watch how they shape policy. In the 19th century, nations industrialized under these logics. Those who controlled issuance shaped outcomes. Britain formalized the model early with the Bank of England, 1694. Paper claims against gold, lending to the crown, expanding supply through credit. Each time paper displaced metal, quality leaked from the system, while the crown and financiers gained leverage to fund wars and colonies without waiting on taxes. Other nations followed. By the 20th century, the Cantillon Playbook wasn't a side effect. It was the strategy. Central banks managed demand and financed states with credit. Banks, funds, and corporations closest to issuance grew larger. Savers absorbed inflation. The structure hardened. Look at 1971, when the U.S. left the gold standard. Money became pure credit. Debt and dollars moved together. Quantity replaced quality. Inflation rose over time. Savings weakened. Investment skewed toward speculation. Cantillon's sequence grew visible. Those near issuance multiplied wealth. Households saw prices outrun income. Pareto's pattern set like drying concrete. Every crisis since then repeats the rhythm. In 2008, liquidity froze. Then trillions of new money arrived. Assets recovered first. Wages trailed. In 2020, checks hit mailboxes after markets were already climbing. Purchasing power eroded as quickly as the cash appeared. This is not cynicism, it's clarity. When you see headlines about rates, deficits, or quantitative easing, you're watching century-old laws operate under modern names. Across cycles, the playbook barely varies. Liquidity shock, lender of last resort response, balance sheet repair via asset purchases, then a hunt for yield that inflates financial claims faster than wages. Think 1987's crash, 1994's bond massacre, 1998's LTCM unwind, 2001's tech overhang, 2012's euro crisis, 2015's China deval, 2019's repo hiccup, and 2022's sprint from stimulus to inflation. Transmission channels repeat as well. Collateral chains rehypothecate the new base money. Risk parity models rebalance into duration. Housing responds with a lag. Labor pricing trails both. Each rescue shifts risk from private balance sheets to public ones, socializing downside while preserving upside optionality for early recipients. Regulatory tweaks follow counter-cyclic buffers, stress tests, liquidity coverage rules. Yet incentives remain oriented toward leverage and duration, because low real rates reward borrowing and scale. By the time policy withdraws support, markets have repriced life's basics: rent, education, healthcare locking, and distributional changes that won't reverse with a single hike. So, how do you act within this structure? Think like an early receiver. Money is a current. It moves fastest near the source. Own assets that float in that current. Businesses, equities, productive real estate. Wages alone arrive later. They adjust after prices. The system rewards ownership more than labor, which is why the wealth gap can widen even in expansions. With each round, credit flows into assets first. Owners benefit twice: rising valuations and access to cheap borrowing. Workers meet the spillover as inflation and debt. Owning productive claims means more than buying tickers. It means aligning skills, networks, and cash flows with engines that convert policy into earnings. Think of three ladders: equity and resilient firms, cash-generative small businesses, and real assets with pricing power. Map your proximity by asking, who pays me, from which pool of liquidity, and with what sensitivity to rates and credit? Prefer activities whose revenues reprice quickly when policy shifts, whose costs are flexible, and whose balance sheets are unfragile. Avoid exposures that depend on constant multiple expansion without cash support. Use cycles, accumulate when liquidity is scarce and narratives are pessimistic. Harvest when credit is abundant and margins peak. Build optionality. Maintain dry powder, cultivate deal flow, and measure risk in cash flow drawdowns rather than headline volatility. And remember, tax and legal structure are part of proximity. Poorly structured gains leak away long before they compound. Consider a simple sequence. The central bank cuts rates and buys bonds. Corporations refinance cheaply and repurchase shares. Investors enjoy higher prices. Executives collect performance pay. A household on the sidelines earns less on savings while rent and housing rise. To keep up, they borrow. That's Cantillon policy translating into life. Extend the chain, lower yields, reprice discount rates, lifting present values, credit desks reopen, syndicated loans clear, and private equity models pencil out richer exits. Mortgage-backed markets thaw, refis cut monthly payments for some, but new buyers face higher sticker prices as cap rates compress. Boards authorize buybacks because EPS optics improve even when unit volumes are flat. Meanwhile, pension funds rebalance from bonds into equities to maintain targets, adding incremental bid pressure. On Main Street, the feedback looks like rising rents, tighter housing inventory, and service prices shadowing asset inflation. Household leverage rises because durable goods are financed over longer terms. Insurance premia and tuition track up with a lag. By the time wage negotiations incorporate the new level, real gains have already been absorbed by living costs. Thus, a top-down policy pulse becomes a bottom-up budget reality within a year. Arbitrageurs, with balance sheet slack, buy time-sensitive assets from distressed sellers, monetize tax shields, and securitize cash flows that households ultimately service. You can see the compounding in data. Decade after decade, top wealth shares increase faster than bottom wealth shares. Index returns concentrate in a small cluster of firms. A few funds control most assets. Scale begets more scale. Early access to capital accelerates compounding, pushing the distribution toward Pareto tails. This is not uniquely American. Japan's long era of low rates and asset purchases favored corporate balance sheets and patient asset holders. In Europe, monetary integration tilted flows toward core economies. In emerging markets, dollar strength can pivot capital against local interests. The rules are mathematical, not national. Mechanically, concentration emerges from feedback loops. Liquidity seeks scale, scale improves margins, margins fund innovation and lobbying, and both reduce competitive threats. Passive vehicles amplify the effect by allocating on market cap, directing fresh inflows to yesterday's winners and starving challengers of capital at the exact moment they need it. Platform dynamics intensify it further. Network effects, data moats, and switching costs raise barriers that only cheap capital and time can surmount. Result: index leadership narrows, volatility migrates to the tails, and career risk pushes allocators to crowd in rather than deviate. Internationally, the rhyme is clear. Japan's zero-rate era enriched balance sheets that could refinance and wait. Peripheral Europe paid higher funding costs while core exporters benefited from currency stability. Emerging markets saw local credit tighten when the dollar firmed, then capital flee to safety. None of this requires malice. It follows pipes and incentives. When capital is cheap, incumbents entrench. When capital is dear, entrants stall. Pareto is the statistical shadow of those plumbing choices. Inevi. What happens when trust thins? Gresham's warning returns. When people fear a decline in quality, they hoard what they believe is scarce land, commodities, productive equities, sometimes digital stores of value. That's the same behavior merchants showed when coins were clipped. Withdraw from debased units, hold what cannot be printed. Policymakers face a trap. Expansion supports growth, but lowers perceived quality, which drives flight to safety. Contraction restores credibility, but slows activity. Confidence becomes the anchor and the vulnerability. As confidence ebbs, pricing becomes reflexive. Higher risk premia lift discount rates, which push valuations lower, which further weakens collateral, tightening credit, precisely when households and firms most need it. Policy sets about rebuilding trust through forward guidance, collateral expansions, and term facilities that swap private risk for public guarantees. But credibility is earned, not declared. Repeated use of extraordinary tools changes expectations about what normal looks like. Investors learn to front-run the put. Households learn to stockpile non-perishables and prepay durable essentials when they can. Flight to quality morphs into flight to scarcity. Prime land, mineral rights, secure cash flows, and capped supply digital assets attract incremental demand. Policy then faces a trilemma: support growth, restore credibility, and contain inflation. Choose two. Lean too hard on stimulus and the currency signal weakens. Lean too hard on austerity and employment buckles. Lean too hard on inflation fighting and debt service crowds out productive investment. That trap is why the anchor drifts from hard backing to narrative management. These laws also shape politics. When the many feel that growth favors the few first, frustration rises. Populism grows. To appease competing claims, governments layer new credit on old promises. Currency value drifts lower. Debt climbs higher. Markets lean on stimulus. Everyone behaves rationally. Voters demand spending. Governments borrow. Banks lend into low rates. Investors chase yield. households borrow to keep pace. Yet the system still degrades. The logic is functional, not moral. Political coalitions respond along predictable lines. Incumbents promise relief through subsidies, tax credits, and targeted transfers, while opposition movements organize around fairness and anti-corruption narratives. Fiscal packages arrive that look counter-cyclical but embed permanent commitments. Deficits become structural as entitlements, interest, and defense outgrow revenue. Central banks, tasked with price stability, drift toward financial stability mandates when market plumbing strains, entrenching fiscal dominance in practice. Meanwhile, local realities tighten. Municipalities refinance at higher spreads. School districts cut programs, and small employers delay hires. The majority feels squeezed and seeks quick fixes. The durable fixes productivity, competition, and credible rules take time. Because every group acts rationally inside its constraints, aggregate outcomes can still drift toward fragility. Rising leverage, shorter planning horizons, and politicized capital allocation. That is the paradox of rational parts producing a brittle whole. Now, look forward. The rails are digital, but the laws remain. Central bank digital currencies are framed as modernization. In practice, they extend precision and control over issuance and access. The sequence persists. Early receivers remain early. Private tokens repeat the pattern too. Insiders hold large allocations early. Later entrants pay higher prices. When weak projects flood the market, good tokens get tucked away while low-quality coins churn. Gresham in code. De-dollarization debates reflect the same structure. Issuers of reserve money enjoy early benefits. Foreign holders get later claims. Over time, diversification emerges into gold, commodities, or alternative units when credibility is questioned. Globally, inflation expresses as a function of credit growth. Sovereign debt becomes both the asset and the collateral that underpins the system. Central banks own vast piles of it, stabilizing markets by standing inside them. That is Cantillon distilled. The state issues, the central bank purchases, commercial banks collateralize, asset prices rise, wages trail. What path remains? The system cannot deflate debt cleanly without crushing collateral, and it cannot inflate forever without eroding purchasing power. The feasible route is management extend maturities, suppress real yields, massage expectations. When faith wobbles, capital pivots to scarcity. Gold bids up, prime real estate attracts. Productive equities hold better, capped supply digital assets draw interest. Each move is rational under Gresham's logic. Trade away what decays for what endures. To navigate the next cycle, study proximity. You can't halt credit creation, but you can move closer to it. Own assets that benefit from early liquidity. Avoid instruments priced only by hope. Diversify forms of money. Track policy in deeds, not speeches. History repeats because incentives repeat. Debased silver helped sink Spain. Britain's paper financed a navy and an empire. Fiat funded wars and welfare in the 20th century. Digital credit now funds almost everything. The interface changes. The engine is the same. You live in a world where prices are assigned by flows of new money as much as by discovery. New issuance rewrites price levels, favoring debtors over savers, owners over earners. You can't wish that away. You can only position within it. Think in decades. If average inflation is 2% for 20 years, half your cash's purchasing power disappears. If asset inflation outruns wages, ownership gaps widen. Pareto's distribution persists unless countered by knowledge and positioning. Governments will respond with redistribution, tighter tracking, new taxes, universal credits, each requiring funding, each adding complexity, each leaning on more debt. The circle tightens. Awareness is an edge. When you understand the laws, you stop chasing noise. You frame stimulus as timing, not salvation. You evaluate policy by where the money lands, not by the press release. You build habits that align with structure, invest early, accumulate scarce assets, minimize fragile liabilities, cultivate skills that plug into productive capital. Gresham warned about quality. Cantillon mapped sequence. Pareto described concentration. Together, they explain why some climb while others tread water. Money is information. Power comes from reading it correctly. Most people study careers, not systems. They trade time for currency without asking who issues it, when it arrives, and at what hidden cost. Once you start asking, patterns snap into focus. You stop reacting. You start planning. We're entering another monetary experiment. Rates shift, debt mounts, trust wobbles. The same laws will decide outcomes again. Those who learn them early will adapt first. Those who ignore them will notice last. You're not outside this story. You're already in it. Every payment, loan, and investment feeds the mechanism. The question is your position within the flow. As you leave this video, think about proximity. Where do you stand? How do you move closer to the source? Which assets hold value when quality drains from the system? These are the questions that separate spectators from participants. If this opened your eyes, tell us where you're tuning in from and what time it is. Your perspective extends the map. Stay alert. Stay informed. The laws of money don't change. Only the players do. If you made it this far, drop a plus in the comments your badge for finishing the deep dive. And if you haven't already, subscribe for more long-form stories where money, history, and power collide. Curious about earlier empires of capital? Check out our others video.